Good morning, everyone. Today we are going to cover a topic on advanced financial management, which is foreign exchange exposure and risk management. So I hope this revisionary class will be extremely helpful for you. To begin with, I'll take up a few concepts quickly, and then we will take up MCQs and case scenarios to understand the concepts better. Firstly, when you talk about foreign exchange, this is the quotation between two countries. So the currencies of two different countries are quoted against each other. And here we have two types of quote. One is American and the other is European. Another way of classifying is direct and indirect quote. So first let us understand what do we mean by direct and indirect quote. As an Indian, if I am an Indian, it makes sense to me that how many rupee I have to pay in order to get, let's say, $1. So if this quote is 87.50, this is a direct quote for me. When the other country's currency, or the foreign currency is treated as commodity, and you are supposed to find out how much rupee you have to pay to buy 1 unit of foreign currency. So how much you have to pay to buy 1 unit of dollar? $1, that is 87.50. So this is a direct quote for an Indian. It is simultaneously an indirect quote for a US citizen. Now, what will be indirect quote for us? Indirect quote for us as Indian would be, in 1 rupee, how many dollars do we get? So 1 upon 87.50, that will give you the indirect quote for an Indian. So the indirect quote says 0.01143. We can round off till 4 decimals when you are presenting your answers, right? So once again, direct quote for an Indian is how many rupees one will have to pay to buy 1 unit of a foreign currency. The foreign currency can be US dollar, euro, pound, any other currency. Whereas indirect quote is for 1 rupee, we are going to get how many USD? 0.0114 USD. This is the indirect quote. What is a direct quote for me? Is a indirect quote for a US citizen here. What is an indirect quote for me? Is a direct quote for a US citizen. Now coming on to what is American term and European term. Any quote which is a direct quote for an American is a American term. So for a US citizen, any direct quote is a American term. Okay. And all others are European quotes. So this one is a American term. And this one is a European quote. Next, we should also understand what is the bid offer and spread. So just like I said, rupee by dollar, which can also be represented as 1 USD equal to INR, how much? So INR 87.5. Now, generally, you don't get the quote like INR 87.50. You get two quotes. One is 87.50 and the other could be 87.90. So these two rates are called bid and ask or offer rate. The bid is the rate at which the bank will buy, and the ask is the price at which the bank sells. So bid and ask, there are quotes, two quotes, which are given for the merchants or all the customers by the banks. So and always bid will be less than ask. So bank will always buy at lower price and bank will always sell at higher price. So bid is the price at which the bank will buy and ask is the price at which the bank will sell the currency to the customers. What is spread? Spread is the difference between bid and ask. Here, as we see, that bid is 87.50 and ask is 87.90. Therefore, the spread between the two is 0.40. This can also be calculated in percentage. Bid minus ask upon bid into 100. So the spread can be also calculated in percentage terms. The important point here is when you are given the bid and ask, and you have to calculate the inverse quotes using this bid and ask. For example, this is the direct quote for rupee to dollar. If I was supposed to inverse it and calculate dollar to rupee, it has to be 1 upon ask oblique 1 upon bid. So the inverse quotes will be 1 upon 87.
Madam, just write little bit font size little bigger.
Okay, I will. And 1 upon 87.50. This will give you the inverse quote. Remember, we have talked that bid is always less than ask. Therefore, if you have a higher denominator, only then you will have this figure as less than ask. So when you are calculating the inverse quote, the bid and ask, 1 upon ask becomes the bid and 1 upon bid becomes the ask. Next important point that I would like to discuss is cross rates. So what are cross rates? So the price for GBP as let's say 110 rupee, the Great British Pound, and USD is 87 rupee. So I have been given two quotes. One is rupee by pound and the other is rupee by USD. Now, if I want to find out USD by pound, so what is that you will get for 1 pound? So if you want to find out how many dollars are available for 1 pound, they are not directly available. They are quoted against rupee. Using this, we can find out what will be the price for 1 pound. How many dollars you will get for 1 pound. Now, if you look at this equation, you see that dollar is in numerator and pound is in denominator. Here, we have the pound in denominator, but the problem is that USD is also in the denominator. So we must reverse or inverse this code. This will become 1 upon 87. So when you multiply rupee by pound into USD by rupee, the rupee gets cancelled and you are left with USD or divide by pound. So 1 upon 87 gives you, either you can calculate it as 0.11 and then you can multiply 110 into 0.11. Okay. Or else what you can do is you can divide directly 110 by 87. Okay. So this will give you 110 divided by 87, which is equal to 1.2643. So what will happen is you will end up getting 1.26 US dollar for per pound. Okay. So 110 will be multiplied by 1 upon 87, or you can directly divide 110 by 87. This is how you find out the cross rates. Next important thing is you must understand what is PIP. This is the price interest point, the smallest unit by which a currency quotation can change. To understand this, if your rupee dollar is given as 87.45, if it can change to 87.46, if it increases, or 87.44 if there is a decrease. So that means if there is a change in exchange rate, 0.01 is the minimum change. This means the PIP for this currency quotation is 0.01. If the price was 87.4528, and then it could have become 87.4529 if there is an increase of 1 pip point, which will mean the pip points are 0.0001. So this is 4 decimals. Why this is important? Pip points are important to determine the forward rate quotation. When you have a forward exchange rate quotation, you might be given that the current exchange rate is 87.4550, and there are swap points or increase in forward points premium, which is, let's say, 25. So if there is an increase of 25, this 25 will be added to the last 2 decimals, and your forward rate would be 87.4575. Okay. So when you have to find out the forward points determination, you have to check how much is the pip point increase or decrease. If it is an increase, this pip points would be added to the last 2 decimals. If this would have been 250, they would have been added to 550. And if it is 2500, 2500 would have been added to 87.4550 plus 0.2500. So this is how you calculate the forward points. If forward point determinations are given, it helps us to calculate the forward exchange rate. But one has to be careful that you have to see the pip points, and basis that you will find out the forward exchange rate. There is another concept of broken period forward rate, which I'll discuss later. And for example, the swap points are given that there is a 25 points increase for after 2 months. and there is a 60-point increase after 3 months. So broken period forward rate, if I want to find out what would be the forward rate after 2.5 months, that is the broken period forward rate. So what you can see is there is an increase of 25 points by the second month, and in the third month, there is a total increase by 60 points. So the total movement between second and third month is of 35 points. And I assume that these 35 points have been increasing evenly in this entire month. So in just 15 days or half month, 35 divided by 2, 17.5 points will increase. So 25 plus 17 or 17.5, that will give me how many stop points will increase after 2.5 months. So this is how you calculate the broken period forward rate. These are some of the basic terminologies you must be aware. And another important thing is there are two types of rates which the banks give. One is the merchant rate and the other is the interbank. Merchant rates are applicable for customers. Interbank rates are applicable when one bank is dealing with another. So generally in merchant banks, the bank will always add some premium as well. They will add some margin, and that margin will also be given along with the quotation. So when you are taking the margin charged by the bank, you have to be careful that margin may be given in percentage, for example, 0.01%. So if the interbank quotation is 87.50 oblique 88, let's say, so bid is 87.50 and ask is 88, but the customer will have to pay 88 plus 0.01% when he is going to buy the currency or dollars, and the customer will get 87.50 minus 0.01% when he sells the dollars to the bank. So margin is always added in ask and subtracted from the bid. So this is what the customer will have to pay, the quotation plus added margin. And this is what the customer will get if he wants to sell the dollars, the bid rate minus the margin charged by the bank. So margins are applicable when there is a merchant banks given by the banks. In case of interbank, the margins may not be applicable. Next, very important concept is the interest rate parity, which is indicative that the prices of the two countries, price of currency or the exchange rate fluctuates and it depends upon the interest rates. So the quotation will change, the exchange rate will fluctuate, and if interest rate parity holds good, the forward rates should always be equal to the spot rate into 1 plus interest rates in the domestic country's currency and divide by 1 plus interest rates in the foreign currency. So this tells us that whatever you are getting in your domestic country, so you will end up getting 1 plus rate of return in the domestic country or whatever the rate of interest is there in the domestic country. It will be compensated by the fluctuation in the forward rate divided by spot rate, 1 plus rate of interest in the foreign currency. So from this, the forward rate F can be calculated as 1 plus RD into S divided by 1 plus RF. To illustrate, let's say the rupee dollar rate is 85. The interest rate prevailing in India is 10% and the interest rate prevailing in US is 4%. And if I want to find out what will be the forward rate after 6 months, so after 6 months, the forward rate would be 85 multiplied by 1.05, that is the interest rate in India, 10% for 1 year. So for 6 months, it will be 10% divided by 2. Similarly, divide by 1 plus interest rate in US. In US, annual interest rate is 4%. Therefore, for 6 months, it would be 2%. So 1.02. 85 into 1.05 divide by 1.02. The forward rate should be 87.50. So let's see, if you have 1 rupee invested in India, together with interest, it will become 1.05. And if the forward exchange rate is 87.50 and spot rate is 85, with the interest in US 1.02, you will be at par. So the loss of interest in US is compensated through increase in price of the foreign exchange or the increase in the exchange rate of US dollars. So 87.5 divided by 85, the 3% loss is compensated by 1.029 increase in the forward rates. So 1.029 into 1.02, you end up getting again 1.05. Why interest rate parity should hold good? Because if interest rate parity will not hold good, there would be arbitrage opportunities. So to avoid arbitrage opportunities, interest rate parity holds good, or covered interest parity. How this will lead to an arbitrage opportunity? So if the interest rates, which are theoretically 87.50 after 6 months, are, let's say, 88, that means people in US would want to invest in India. And if they are less, then people would like to invest in US. So this is the reason it will create a arbitrage opportunity. So theoretically, the forward rate should be 87.50. Otherwise, it will create a arbitrage opportunity. From interest rate parity, one observation we have, you must note that the currency is at premium if the rate of interest is less in that country. So if India has more interest rate as compared to US, the Indian currency will be at discount and the US currency will be at premium. So that country's currency is at premium where the rate of interest is less as compared to the other country. Here in India, the rate of interest was 10%. In US, it was 4%. So the rate of interest is less in US. Therefore, the US currency or dollar will be at premium, which we can see how the rate of dollar was 85 and the dollar price increased from 85 to 87.50. So here the dollar is at premium. Is this clear? Just like interest rate parity, there is another theory which covers purchasing power parity. Purchasing power parity caters to inflation. So it says that if there are two different countries which have different inflation rates, so to hold purchasing power parity, once again, the forward rate should be equal to spot multiplied by 1 plus inflation rate in the country of domestic country divided by 1 plus inflation in the foreign country's currency. Example, inflation in India (6% per annum). Inflation in US (3% per annum). Current spot price of rupee by dollar is, let's say, 88.20. What should be the forward price? Forward price as per this formula should be 88.20 multiplied by 1 plus inflation in India. Now, forward price I'm calculating, let's say, after 3 months. What is the 3 months forward price? So 1 plus inflation in India, 6% per annum is equivalent to 1.5% for 3 months. 3% per annum is equivalent to 0.75% for 3 months. So this will become 1.015 divided by 1.0075. To calculate these figures quickly, how do you get 1.015? This is 6 divided by 400 plus 1. Why 400? Because we are taking for 1/4 of a year, quarterly. And 1.0075, how do we calculate this? 3 divided by 400 plus 1. So that is the quickest way in which you can calculate these figures. If it had been semi-annual or for 6 months, I would have divided by 200. If it had been for next month, monthly, I would have divided it by 1200. Okay. So 6 divided by 400 quickly plus 1. That will give you the factor as 1.015. And 3 divided by 400 plus 1 will give you quickly 1.0075. So try to follow some methods which ease up your calculations and make them fast. So what should be the theoretical forward rate after 3 months if purchasing power parity holds good? It should be 88.2 into 1.015 and divide by 1.0075. Theoretically, rounded off to 4 decimals, the 3 months forward exchange rate should be 88.8566 if purchasing power parity holds good. Once again, the US dollar is at premium. So we conclude that where inflation is less, that currency will be at premium, right? How arbitrage opportunity arise? So if the forward price was not 88, it was 89 or 90, more than 88.8566, there again would be an arbitrage opportunity. What will happen? People will take $1 in US and convert it into Indian rupee or 88.20, buy products in Indian market, and when they will there will be more inflation in India as compared to US. So they will sell it in the US market and then convert it into dollars. So they will end up getting more dollars as they would have got in India by selling those products. So arbitrage opportunity will arrive or arise if the theoretical forward rate is not 88.8566. So both the theories are important, interest rate and purchasing power parity. That's why we say that Fisher effect takes care of interest as well as inflation together. So that is another theory in exchange rate, which is the Fisher parity. Now, we have seen that forward rates are there. So if you calculate the forward rates using interest rate parity, you will get the answer. What should be the forward rate? If you have the forward rate using purchasing power parity, you can calculate the forward rates. So we have two types of rate. One is the spot rate, which is the prevailing rate today, and one is the forward rates. Now, supposing rupee by pound, the spot rates are 110.50 oblique 110.80. So these are the forward rates. These are the spot rates. How can I determine the forward rate? I have just seen that forward rates can be determined using purchasing power parity or interest rate parity. But sometimes the swap points are given. So I can apply the swap points also. So if swap points are given as, let's say, 30 oblique 50, what will be the forward rates? The forward rates would be 110.50 plus 0.30. So they will be 110.80 would be the new bid rate. And for ask, 110.80 plus 0.50. There are two pip points, 0.01. Therefore, these two rates will be for 2 decimals. So they should be added to 80 and 50. So 30 will be added to 50 and 50 will be added to 80. This becomes 111.30. So the new forward rates will be 110.80 oblique 111.30. So let's say these are swap points for 3 months. It means the forward rate after 3 months would be this. What if swap points were 30-20? Then the forward rates after 3 months would be 110.50 minus 0.30, 110.20, oblique 110.80 minus 0.20, which is 110.60. So the important point to note here is if your swap points are 30-50, that means 30 oblique 30 plus something. So there is a increase. These swap points must be added to the spot. But if your swap points are 30-20, that means 30 oblique 30 minus something. So there is a decrease. Then you have to subtract the swap points from the spot. This means that the pound is at premium. The rate of dollar pound is increasing by 30 and 50 in the bid and the ask. This means the pound is at discount. The price of pound has come down by 30 and 20. So the 30 will be decreased from the bid and 20 will be decreased from the ask. So this is very important to understand whether the swap points show an increasing value or decreasing. If they are increasing, they must be added to the spot. If they are decreasing, they must be subtracted from the spot. Here we will discuss about the broken period swap points also. So broken period forward rate calculation using swap points. Once again, let us say the spot rate today is rupee by euro, 105 oblique 106. Swap points 3 months, 30-40. Swap points 4 months, 40-60. So this means that after 3 months, the forward rate would be 105.30 oblique 106.40. And the forward rate after 4 months would be 105.40 oblique 106.60. Right? Now, if I am asked what would be the forward rate after 3.5 months. So you can do it the calculation in two ways. What is the increase in the bid side? 10. So 10 increase of 10 after 1 month. So after half month, there would be an increase of 5. Just like we interpolate. So since it has moved from 30 to 40 in a month, therefore, what will be there exactly in the middle? 35. Similarly, 40 to 60. So what will be there in half month? You can interpolate and 50. So swap points would be 35 and 50 after 3.5 months. So after 3.5 months, the exchange rate should be 105.35 oblique 106.50. Why I am showing you like this is you can also verify your answer by taking the average of the two from 105.30 to 105.40. In the exactly the middle would be 105.35 and 106.50. This is when you have the swap points increasing after 3 months as well as after 4 months. Your answer, I hope so far it is clear. Your answer will also change if I make a small change here. If after 3 months it was 30-40, and if after 4 months it was, let's say, not 40-60, but 40-30. So what does it mean? That after 3 months there was an increase, but after 4 months the exchange rate there was a decrease, right? In that case, the forward rates here would be same as 105.30 oblique 106.40. But here the forward rates would be 104.60 when you subtract 40 from 105.00. So 105.00 minus 0.40. So you get the exchange rate as 104.60. And then there is 30. So 106.00 minus 0.30, it becomes 105.70. So it's not an increase, it's a fall from 3 months to 4 months. From third month till third month, the currency was at premium. Euros were at premium. But something happened after the third month that the value of the currency came down and euro was at discount. Now, if you will take the average of these two from 105.30 to 104.60, you will find that the average or the center in the center exactly after 3.5 months, the forward rate would be the average of the two. So you're moving from 105.30 to 104.60, which means there is a change of 70. So here you will have 104.95. Okay. So after 3.5 months, it will be 104.95. Now using swap rates, how you can calculate that? So if you take a number line, you were here and you moved 30 points ahead. And now you have moved, after 30 points, you moved 40 points below. So technically, there is a movement of 10 points in the negative direction. So exactly in the middle, how much would be the movement? 5 points decrease. So 105.00 minus 0.05, you will get 104.9. So in that case, you cannot say simply 30 and 40, the average is 35. No, 30 and 40 was an increase, and then 40 and 30 is a decrease. So after having moved 30 points above, you have come down 40 points from there. So net movement in this period is total of 10 in the decrease, and therefore in half a month, there would be only 0.505 decrease. Okay. So this is how you find the broken period forward rates. If swap points for 3 and 4 months are given, and you have to find the points somewhere in the 3.5 months, right? So I hope the basics are clear so far. Let us now calculate the premium or discount. Once again, let me take a quote, let's say rupee to euro. The quotes are 105.70 oblique 106.85. And the forward rate is given. Let's say it's already given 106.75 oblique 107.1.05. So it must be more than 1.05, 1.1. So 106, 7.95. This means euro is increasing and euro is at premium. Implies if euro is at premium, rupee is at discount. Now, what is the percentage premium? That can be determined by forward rate minus spot divided by spot into 100. So this is 106.75 minus 105.70 divided by 105.70 into 100. So it is 1.05 divided by 105.70 into 100. A little less than 10%. So 9.93% premium. If these forward rates are after 1 year, then definitely the premium is 9.93%. But if they are after 6 months, then you can annualize the premium. So the annualized premium would be 9.93 for 6 months. Therefore, for a year, it would be into 12 by 6 or into 2, you can do directly. The annual premium would be 19.86%. So this is your formula to calculate the premium. Now, this also means that the rupee is at discount. So how much is the discount on rupee? Is it also 9.93% and 19.87% annualized? No. I have calculated this only for the bid. Similarly, you can calculate for the ask. But the discount on rupee is not 9.93% for 6 months. So in order to calculate the discount on rupee, there are two ways in which you can approach. One, you can calculate the inverse quote. So the inverse quote here would be, again, I'll calculate for bid 1 upon 106.85. It will come out to be different because I'm using a different rate. Or and the ask would and the bid for after 6 months would be 1 upon 107.95. So definitely this will give you a different answers without any doubt. The discount will not come out to be same because we are not even using these figures. Let's say even if the figures did not change, even if the rate was given as 105.70 only and 106.75. So if I use these rates only in the inverse quote, will I get still 9.93? The answer is still no. So even if I had used the rupee euro inverse as 1 upon 105.70, and after 6 months, 1 upon 106.75. I'll repeat here. These were the rates given for euro against rupee. Bid and ask both were given. And we saw that the price of euro has increased. So we calculated the premium for the bid and it came out to be 9.93%. Let us say ask rates are not given, only bid one quotation is given, bid and ask are not given. So if only 105.70 and 106.75 is given, to calculate the discount on rupee, I will take the inverse quote 1 upon 105.70 and 1 upon 106.75 using the same rates which we have used in the previous calculation, not using the actual bid and ask if bid and ask is given. So when you use these rates, the rupee quotation for euro against rupee is 1 divided by 105.7. This is and this one is 1 divided by 106.75. So if I have to calculate the discount, once again, I'll apply the same formula. Forward minus spot divide by spot into 100. This time the forward is less, so my answer would be negative. A negative answer indicates in this formula that it is a discount. A positive answer in this formula indicates it's a premium. So 0.009367 minus 0.00946. I'll keep it the decimal same, ignoring this. And divide by 0.00946. So this comes out to be 0.0001 upon 0.00946 into 100. So the discount percentage is not 9.93, but it is 10.57. So you get a different percentage of discount. This is same thing as price cannot be calculated. Like if you have a profit, the profit percentage is not same on cost and sale. It is different. Same is applicable here. So the negative percentage indicates, yes, there's someone who has raised a hand. Please let me know. Re-explain the logic of swap. Okay. Yeah, Shailendra, I'll just do that. Okay. The logic of swap is that here the prices have increased. When you see the swap points as, I'll take a blank slide somewhere. When swap points 1.05, I'll just check that. Okay. When swap points are 30, 40, so when they are increasing, that means the price have increased of denominator currency. Denominator currency means against which we are calculating the direct quote for us. So if rupee by dollar was 88.5030 and 88.9070, and there is a swap point decrease of 30, 40. This means dollar is at premium and you must add the swap points to find out the forward rate. So it becomes 88.5060. This time the pip points are 0.0001. So 30 means 0.0030. So this number would be added to the last two digits. Similarly, 0.9070, we will add 0.0040. So 88.9070 plus 0.0040. This will give you 88.911. You have to see this is less. If just like bid and ask, if this figure is less than this, that means the dollar is at premium and you must add the swap points to find out the forward rate. However, if this would have been 40-30, I would not have added 40 to 5030. I would have rather subtracted. So my forward points would have been 55.88 4990, and 30 would have been subtracted from 88.9070. So this would be 88.9040. So when these are decreasing 40-30, the first number is bigger than the second. That means swap is decreasing is to be subtracted. To find forward rates, swap is to be subtracted. Is this clear? So if it is 30-40, add. If it is 40-30, subtract. So again, if it is 20-80, add. If it is 40-10, subtract. This is about how you add or subtract swap points. The second thing was about the broken point. So if after 3 months it is 30-40, or if after 2 months it is 30-40, and after 3 months it is 40-60. So this means the price is increasing. It has reached till 30 in 2 months, and after 3 months it has reached till 40. Where would it be after 2.5 months? Clearly, 35 points would be the swap points for 2.5 months. Similarly, 40 to 60, so after 2.5 months, it would be 50 in between. Okay, so you can find out the broken period forward rates also, because it was increasing after 2 months and it continued to increase after 3 months also.
Ma'am, is it the average we'll have to take na, for
Yes,
this?
kind of we are taking average, just like interpolation. A simple example of interpolation is if in 10th your score was 85% and in 12th your score was 90%. So interpolation means in 11th your score was 87.5. Similarly, between 11th and 12th, midterm of 11th, it again becomes 88.75. So you kind of interpolate. We assume it to be a linear function. Okay?
Okay, ma'am. Thank you.
Right. But it is only possible when there is a continuous increase. Just see if it was 30-40. Change the color so that there is no confusion. If it was 30-40 after 2 months, and after 3 months it is 40-30. So this is indicating that there was an increase from 0 month to 2 month. So you reached till 30. And then there is a decline from here of 40 points. Okay. So technically from the very beginning, in between, there is a total movement is of 70 points. You have lost your 30 original and then you have moved another 10 points below. So there is a loss of this. So here, if you look at the middle, total loss from the beginning is only 10, minus 10. So you will be minus 5 from the original price. Okay. So this is how you find the broken period swap points. If it is continuous increase, no problem. But if it is increase and then decrease, or if it is decrease and then increase, you have to see the total movement that has been there. So the total movement that has been there is after having gone plus 30, you have come down to minus 10, minus 40. So plus 30 and minus 40 is minus 10. So from the beginning, it is minus 5. Okay. It could be decrease and then increase. So you have to see the total movement. Okay.
Thank you.
Thank you, ma'am. Yes, sure.
So, okay, this is coming out to be 1.57. Yeah, it may. I also checked. So it is 1% something. So see the discount, which appeared to be 9.93%, is turning out to be something else when you are calculating the discount. But it will not be so much difference. This difference is just because the figures are rounded off, whereas there almost exact figures were taken. So if I take a quick, simple figure, you will be able to understand. Let me do it here. Rupee by dollar was 50. And then rupee by dollar becomes 100. So what is the premium on dollar? if you apply this formula, forward 100 minus 50 upon 50 into 100. So 50 on 50 is 100%, right? So dollar is at 100% premium. But if we want to calculate the discount, so take the inverse price. If you will calculate the 1 by 50 is 0.02, and here dollar by rupee 1 by 100 is 0.01. Now if we calculate same premium or discount on rupee, it will be forward minus spot. 0.01 minus 0.02 divide by spot, divide by 0.02 into 100. So this comes out to be 50%. So premium on dollar is 100%, but the discount, because it is coming out to be negative, but the discount on rupee is 50%, right? So this can also be calculated directly without taking the inverse quotes. Then your formula would be spot minus forward divide by forward into 100. So apply this formula here in this quote only without taking the inverse. So it is 50 minus 100 upon 100 into 100. So it comes out to be 50%. So what I'm trying to tell here is there are two ways in which we can the premium or discount. The formula to calculate the premium is forward minus spot divide by spot into 100. This gives you the premium or discount for the denominator currency, right? So if you have written rupee by dollar, this formula will tell you premium or discount for dollars. If it is positive, that means dollar is at premium. If it is negative, dollar is at discount. But to calculate the corresponding discount or premium on numerator currency, there are two ways. Either you can take the inverse quote, so that numerator currency will now become the denominator, and you can use the same formula. Else, you can quickly change your formula, forward minus spot, divide by forward. Or you can say spot minus forward, divide by forward. Right? So if you divide by spot, you get the premium or discount on the denominator currency. And if you divide by the forward rates, you get the premium or discount on the numerator currency. By looking at the increase in price, you can make out that the dollar is at premium, therefore rupee is at discount, instead of looking at the positive or negative. Right? So to sum up, for denominator currency, forward minus spot divide by spot into 100. And for numerator currency, forward minus spot divide by forward into 100. If you want to look at the plus, this will give you premium minus discount. Here, because I've changed forward minus spot, so don't go by plus and minus sign, or you can alternatively use spot minus forward upon forward. Then again, same thing is applicable. If it is negative, it is discount, and positive is premium. Right? So these are the different ways. So let's take one question here, one MCQ, and tell me the answer. Spot USD versus INR is 83.00. 3-month forward is 83.40. What is the forward rate? Is it a discount or premium? Which currency is at premium? First, you have to see which currency is at premium. This is not USD by INR. This is 1 USD to INR. That means 1 USD will be available for 83.00 rupee. Can also be written as rupee by dollar. 83.00 in the spot. And in the forward market, it is 83.40. Which currency is at premium? Dollar has become cheaper or dearer? More expensive. Okay, Shailendra is saying B is the answer. That's true. Dollar has become more expensive. So dollar is at premium. By how much? By 40 paisa. Okay. Dollar is at premium by 40 paisa. B is the correct answer. If I have to find out premium percentage, then forward minus the spot divide by spot into 100. Is this the right answer? Is this the right answer for premium? This is 0.48. Zero 0.4819%. This is only for 3 months. So you have to find out the annual premium. Multiply it by 4. So annual premium is 1.927%. Dollar is at premium. And what is the premium? 1.927% annualized. For 3 months, the premium percentage is 0.4819. How much is the rupee at discount? If dollar is at premium, rupee is at discount. So 83 minus 83.40, spot minus forward, divide by forward. The discount is 0.4796%. So it's not coming out to be same. It is a little less, right? 0.4796 and annualized discount is 1.918. Okay. If you would have calculated the inverse rates first, 1 upon 83 and 1 upon 83.40 as the new forward rates, then also you could have calculated the discount on rupee using the same formula as forward minus spot divided by spot. Okay? Is it clear? Team, I can give you a break. If it is required, let me know for 10 minutes. Okay. Okay, I'm leaving you with this question and I'm also giving you a break. So those of you who want to try this question can try. Others can go for a 10 minutes break. What is given is spot $1 is available for 7.50 French francs. You have to find out the missing information for 3 months, 6 months, 1 year. So these are some small multiple type questions can come from this type of questions. What is the forward French franc per dollar if interest rate parity holds good? What is the forward discount on French francs after 3 months? After 6 months, you have to find out what is the interest rate in France, what is the forward France French franc rates if the forward French rates are at a 2% annualized discount. After 1 year, what is the dollar interest rate in US if the interest rate in France is 10% and the forward French franc per dollar is 7.52. Also calculate the discount on French francs per annum. Now, when you are saying discount on French francs, one thing is for sure that this answer should be less than 10%. Again, here you have the French francs as on discount. Therefore, this answer should be more than 12%. You know that this currency is at discount, indicative that the interest rate in France is higher than prevailing in US. Here also, you are asking discount. This time, I'm not sure like this, if it comes out to be positive, it may be at premium also. But if I take this figure as true, that this is also going to be a discount, then this figure should be less than 10%. So here 6 and 8, you have to find out the forward French franc rate and the forward discount on French franc using interest rate parity. Okay, so I'm giving you a 10 minutes break. Correspondingly, you can also try this question in the meantime to give these answers. Yes or no? What is the answer for this? And this should give you interest rates in France, 13 point something. $13.97. Then this calculation, what is the dollar interest rate? So you know the US, France interest rate, 10%, and this is only for 1 year. So 7.5 into 1.1 and divide by 7.52. That should give you the interest rate in France, in US, sorry, which is 9.707. And to calculate the discount on French francs, 7.52 minus 7.5 divide by 7.52 into 100. So it's 0.266%. Negligible difference between the interest rate in France and in dollars, only point 2 point something. So that is what the difference is coming out to be here. You will also see that generally, closely, the interest rate differentials are the discount or forward. So here is 12% and 13.97%, almost 2%. Here it is 10% and 9.707%, so almost 0.2 to 6% or to 7%. Again, here it is 6% and 8%, so almost 2% for the annually. Okay. I hope you have done all this. Next, a small topic, which is Nostro account, Vostro account, and Loro accounts. So what are Nostro accounts, Loro accounts, and Vostro accounts? Nostro accounts is my account with you. So for example, a bank in India, let's say SBI, keeping funds in, let's say, Citibank US in dollars. Vostro account, your account with us, let's say Citibank US having account with SBI India or HDFC or any other bank, keeping money in rupees. And Loro is your account with them. Or their account with them rather. So for example, if Bank of India wants to pay dollars for his client's import. Okay, so Bank of India in India has a client, a customer who has done imports, and now he wants to pay dollars to that person in US. But Bank of India doesn't have a dollar account in US on its own. So it seeks help from SBI India, which has a Nostro account with Citibank in US. And Bank of India requests the SBI to make the payment through their Citibank account in US. So that's a Loro account. So Bank of India is using SBI's Nostro account in US with the Citibank to make the payment for his client's dollar to the US exporter. Okay, so these are the three accounts that we talk about: Nostro account, Vostro account, and Loro account. When you are asked a question on how something like a Loro account or a Vostro account or a Nostro account, how do you look at this? How do you maintain the balance? How do you calculate the debits and credits? So suppose you are a dealer of ABC Bank on 20th October 2014. This is illustration from your study material only. I've just taken it to explain. So they have a balance in the Nostro account with XYZ Bank in London, which is 65,000 pounds. So ABC Bank in India is having a Nostro account in London where it is having a balance of 65,000 pounds and also a exchange position overbought 35,000. Then the following transactions have taken place during the day. What steps would you take if you're required to maintain a credit balance of 7,500 in the Nostro account and keep a overbought position of 7,500? So you have to understand one thing. The exchange position is impacted by any contract that you take, whether it is a forward contract, whether it is a DD purchased or anything. So whether or not cash settlement is happening or not, the exchange position gets impacted. However, the credit balance of 65,000 pounds is the cash balance. This will move only when there is a cash movement or a cash transaction, when physical delivery of any contract is taken or given. So we calculate two positions. One is the exchange position, where you have forward contracts, etc. And one is the cash position. So you have debits and credits in the cash position. So you already have an opening balance, which is pound 65,000, a credit balance. So whenever you will have funds in this account, you will credit. Whenever you will pay someone, you will debit, just like the bank statement. And the exchange position has an overbought position of pound 35,000. So overbought position. So purchases will be here and once again credits and sales. So you have a overbought position of 35,000 already. Now, if you purchase DD, right? So I'll take the exchange position here also. You already had 35,000 pounds overbought position. Then you have purchased DDs, 12,500. but no cash has moved. Then you have purchased a bill on London, which means 40,000 purchased. Then you have sold forward TT. So when you have sold, the position will go down by, overbought position will go down by 30,000. It would be squared off to some extent. Forward purchase contract cancelled. So there must have been some overbought position which has now been cancelled. Then remitted by TT. This is also money gone. However, when you have remitted by telegraphic transfer, 37,500 will also move in the cash account. So your cash position is credited by 37,500. So any cash settlement will impact the exchange position as well as the cash. Purchasing a DD, purchasing a bill, forward telegraphic transfer, forward purchase cancelled. All these are non-cash items. No physical movement of cash is there in this. But exchange position is impacted. However, this is impacting both the cash position as well as the exchange. Finally, draft on London cancelled. Okay. So that means you have issued a draft, but it has now been cancelled. So you will get back the position. So draft on London cancelled. Right? So you can see what is your exchange position now, 35,000 plus 12,500 plus 40,000. And another item of 15,000. So you have the debits of 102 purchases, 102 500 credits, and debit is and debit sides you have 30,000 plus 15,000 plus 37,500. So sale position is 82,500, which is an indicative that you have an overbought position still of 20,000 pounds. So still you have a overbought position balancing of 20,000 pounds. Okay. And cash position is that you have a credit balance of 27,500. Credit balance 27,500. Right? 37,500 plus 27,500 is 65,000, right? What is required? What steps would you take if you want to maintain a credit balance of 7,500 pounds only in the Nostro account and keep an overbought position of 7,500 in the exchange? So you want to keep this as 7,500 only. So what will you do? You will sell the pounds, 20,000. So if you sell 20,000 pounds, now your credit position will be only 7,500. So you had an overbought position of 27,500 Out of that, you sold 20,000 pounds, and now you have a credit balance of 7,500. Okay. But when you sell these pounds, this will also be reflected here. So there was an overbought position of 20,000, and now you have sold 20,000 pounds. So this position is nil. And if you want to keep a overbought position of 7,500, you will have to buy forward TT for pound 75. Okay. So this is how you manage a questions if you have a nostro or a vostro account question. You have to look that exchange position is impacted by all transactions. Cash position is impacted only by the cash transaction. So already you had a 35,000 pounds, then you are buying, which will add to the exchange position. Buying DD will add to exchange position only. Purchasing a bill will add to exchange position only. Selling forward TT will impact the exchange position only, but this time it is a sell, so you will subtract. Forward purchase was cancelled is equivalent to another reduction in the balance of bought position. Then remittance will impact not just an outflow or sale position and sale in the exchange position, but also in the cash position. So this is only the item which is impacting both cash and exchange. And draft on London cancelled will again equivalent to purchase buy. When you did all these calculations, you saw that you had an overbought position of 20,000 and your cash was 27,500 credit. It was further required that the credit balance should only be 7,500. So you sold the 20,000 pounds so that your credit balance in the cash account should only be in the Nostro account of 7,500. But when you sold the dollars, it will also exchange your sold the pounds, it will impact your exchange position. That will also get reduced by 20,000. So there was an overbought position of 20,000. Now you have sold 20,000. So this exchange position becomes zero, nil. Whereas you also wanted to have an overbought position of 7,500. So you will buy a forward TT again of 7,500 pounds. Right? This is how you manage the Nostro account type questions. Next, now we have understood the fundamentals of foreign exchange. What are quotes? What are forward rates? What are spot rates? What are the fluctuations, interest rate parity, purchasing power parity, as well as we have also just discussed the Nostro account. Apart from this, foreign currency is always fluctuating. And if you are already exposed, if you have some transactions in foreign currency, if you have to make a payment, so you have some exposure because of the foreign currency. This exposure can be your translation exposure, operating exposure, or transaction exposure. What is the difference? Translation exposure occurs when, for example, you have a subsidiary in US and you are now trying to consolidate the accounts and your reporting currency is Indian. So you are the parent company, you want to prepare a consolidated accounts and reporting currency is Indian rupee. What you are supposed to do now is to translate the entire balance sheet and profit and loss statement of the US subsidiary from dollars to rupee. In that, you may face some adverse loss or profit because of that translation, but you are definitely exposed. Operating exposure is, let's say, I am making a sale to US customers or clients continuously. This is my operations. And now if I look at the situation, the way dollar is increasing continuously, I'm standing to gain through this operating exposure. However, if I had been importing goods, then it would have been a lost to me. So that is the operating exposure. Transaction exposure happens when you have already entered into a deal or a transaction. The something has been exchanged already, and then there is an exchange rate fluctuation, and then after that the payment is to be made. So if I bought the machinery from US on 1st January, the payment for which is to be made on 31st March, I am definitely standing to lose if dollar is increasing. So that's my transaction exposure. I have entered into one transaction for which I have to make the payment later, and in between the foreign exchange rate has fluctuated. So these are the exposures that we face when we are dealing with foreign currency. I hope you understand. Translation occurs when you are translating the subsidiaries accounts into your own rupee or reporting currency to consolidate the accounts. Operating happens when you are regularly doing a business into a particular product, buying or selling, and every time there is a change in what your revenues or your expenses are because of the exchange rate fluctuation. Transaction exposure occurs when you have already made one transaction or transactions, whereas the transaction was made earlier, but the payment of the same would be made at a later point of time. And in between, there is always a fear that the exchange rate may fluctuate. Now, having understood the three types of exposure, we must also protect ourselves from this risk, the risk of the foreign currency fluctuation. How will you cover up yourself against this risk? There are various ways in which you can do it. Derivative market is definitely one of the very good ways in which you can do it. So derivative markets provides you with forward contracts, future contracts, options, and you can also make for swap arrangements. Another one of the very good method is money market hedge. So that will also help you protect. When I use the word hedge, that means I am already having some exposure and I want to protect myself. If I am not having anything to do with dollars, I have not made any transaction, no subsidiary, I don't sell to the clients in US, I don't buy any raw material from them. So I'm neither having any translation, neither operating, nor any transaction exposure. Despite that, if I enter into a forward contract to buy dollars or to sell dollars, I'm speculating. I'm not hedging. Hedging is, which means you are already exposed. So you are trying to cover up yourself or to protect yourself against the fluctuation in the exchange rate. So money market hedge is one of the very good ways. Another way is netting. So instead of if I have to make a payment of certain dollars and some other person has to make a payment of certain euros to me and some other person has to be paid pounds or maybe euros or same currency. So I should do the netting instead of taking the dollars as well as paying the dollars. I should do the netting that at least reduces my risk in foreign currency. So if I have $100,000 to pay and $80,000 to receive, my exposure will only be for $20,000. Netting is one of the ways. Leading and lagging are one of the ways. Leading helps you to make the payment beforehand. So when you think that you have to make a payment and the price of the currency is going to rise, you can make the payment beforehand. And if you have to make a payment and you think that the price of the currency is going to fall, you can delay the payment. So through this case scenario, I'm going to make you understand how do we do a money market hedge. Let us look at this. There is an Indian exporting firm. This word is very important when you're looking at the foreign exchange. So when you are exporting, that means this one particular word tells me that you will be receiving foreign currency. You are the receiver of foreign currency. And when you are a receiver of foreign currency, it indicates that you fear that it should not fall. You are okay if the price increases of the foreign currency, but you have problem if the price of the foreign currency falls. That is a loss to you. So it's an asset. Receiving foreign currency means you have receivables, asset. And you always fear the decrease in value of asset, not increase. Okay. So the moment you see Indian exporter, you understand that you are receiving foreign currency, you have receivables, and you are wanting to cover yourself against the risk of fall in the prices of the dollars. So Rohit and brothers have exported goods worth Australian dollar 1 million to the importer in Sydney. So your foreign currency that you are dealing with is Australian dollar to the tune of 1 million, right? So you have 1 million Australian dollars receivable. So like I said, so you are worried about the fall in the prices of the Australian dollar in near future, as it is likely that the export sum will be received after 3 months. So if you are sure that the price of the Australian dollar in next 3 months will not decline, it's perfectly okay. But because you have Australian dollar receivables, you are fearing the fall in the price of Australian dollar against Indian rupee. So you don't want the rupee to be at premium. You are okay if the rupee is at discount, but you don't want the rupee to be at premium and Australian dollar to be at discount. Now, today, as such, there is no derivative contract available. So you don't have any derivative contract available in Australian dollar so that you could hedge against yourself against this risk. So what do? What is given is spot rate and 3 months interest rate in India and in Australia. Okay. I hope you've understood the question. You are an Indian exporter, right? Australian dollar is what you are going to receive, and you don't want the price of the Australian dollar to fall. But you don't have any derivative contract, no forward, no future, no options. So what will you do? Can you try to give the answer to this question? Forward contract is a derivative contract. Is it available? Uh, Sachi Asthana, you're saying screen not visible. Is it visible now? Others can see the screen and they're giving the answers. All right. So forward contract is a derivative contract. It is not available. Future contract is a derivative contract. It is again not available. Options are also derivatives. This is also not available. So what option do you have? Money market hedge. So first we'll understand and then we'll attempt the MCQs. Okay. So this is one of the very easy ways. If you will write these steps, you will be able to easily calculate the money market hedge, how it works. First, you see whether you have an asset or a liability. So if you are an exporter in India, you will have asset. As we can see here that we have asset. If I had been an importer, it could have been a liability. So it means I have receivables, which is an asset, which is 1 million Australian dollar. Now, before I proceed further, just see how the money market mechanism works. Today, the contract is done. After 3 months, today I have exported. After 3 months, I'm going to receive Australian dollar 1 million. Okay. So if you can offset this position means if you can do something that you have exactly 1 million US or Australian dollars payable. So if exactly after 3 months you create a situation where you have to pay Australian dollar 1 million. So you will receive and simultaneously you will make the payment. So if Australian dollar at this time is 1 rupee, it doesn't impact you. If it is 500 rupee, even then it doesn't impact you. Why? Whatever you are receiving, you are paying to some other party. So you create a opposite position in such a way that you have exactly same amount of foreign currency payable. So if you have an asset receivable, you create a payable. If you have liability payables today, then create a receivable. So just take the opposite position. So you had receivables $1 million, create a liability so that you have payables $1 million exact Australian dollar after 3 months. Okay. So you have to pay 1 million Australian dollar after 3 months. You are creating that kind of a situation. Now, why will you pay Australian dollar after 3 months? You will pay if you borrow today. Okay. So if you borrow today, you will have 1 million to repay that loan. So if you borrow today, but how much will you borrow? You will not borrow 1 million. Present value of 1 million Australian dollar, because you have to pay together with interest, and we don't want to increase our liability beyond $1 million Australian dollars. So what we want is after 3 months, when we receive 1 million Australian dollar, we end up paying exactly 1 million Australian dollars. So together with interest, it should be 1 million, which means you're not going to borrow 1 million today. You're going to borrow the present value of 1 million US dollar, Australian dollar. How will we find the present value of 1 million Australian dollar? We will look at, because we are borrowing in Australian dollars, we will see what is the rate of interest prevailing in Australia. So the rate of interest which is prevailing in Australia is 5% per annum, which means for 3 months it is, once again you can follow, 3 months is 1 quarter. So 5 divided by 400 plus 1 will give you the answer, which will be 1.0125. You can check it quickly. 5 divided by 400 plus 1. So 1.0125. So borrow the present value of 1 million. So 1 million divided by 1.0125. So you need to borrow only this much. You need to borrow 9,87,654.321. Okay. I'll take the two decimals for the time being. If there is no specific requirement as to how many decimals you have to round off, do you need to round off the intermittent answers also to 2 decimals or 4 decimals? You'll do that. Otherwise, howsoever you are rounding off, you will mention it as a note that we have assumed for. So practically, it might not be possible. Practically, you might be. We have some rules also that passes are to be rounded off whenever you're doing a foreign exchange calculation. But since we have Australian dollar here, I'm assuming 0.32 as the decimal. I'm taking it till 2 decimals. Now, today I have borrowed the present value of 1 million US dollar, Australian dollar. So I have in my hand 9,87,654.32 dollars. What do I do with this? I'm an Indian, so I need to convert it into Indian rupee. So I'll convert it into Indian rupee using spot rate. Remember here, the bid and ask is not given. So if it had been 56/57, you would have been able to convert it using bid. Because you had dollars, you will sell it to the bank. Bank will buy at 56. If it was an opposite position, you would have applied the ask rate. So bid rate would be applicable. Here there is only one rate, but in this situation, bid would be applicable. So 987654 into 56, you end up getting 55 lakhs 30,000, 55 lakhs 30,000 8641. Okay, it's 5 crores, sorry. Five crores 53 lakhs 8,641 rupees. This I will round off in absolute number because this is the rule in India. We know, we are aware of it. So this I'll not keep it to paisa. Now you have this much money today. What do you want to do? You can keep it in the bank. So you can lend it. So when you lend it, once again, the rate of interest applicable in India is 12%. Here also, there can be two rates, borrowing and lending rates. So if it had been 4.8/5.2, so you were borrowing, 5.2 would be applicable. And here you are spending, lending. So when you are depositing, the deposit rates or lending rate will be less. So it's generally lending or depositing versus borrowing. Borrowing rates are always higher and the lending or depositing rates are less. So if he had needed to invest in Australia, he would have got 4.8%. But if he has to borrow in Australia, it is 5.2. So what did he do? 1 million Australian dollar is required to be payables. For that, he borrowed the present value of $1 million at 5%, converted it into Indian rupees at the rate of 56, and then invested or deposited that money in India at 12% per annum. So he will deposit 5 crores 53 lakh 8,641 at 12% in India, which is 3%, 12% per annum, or 3% for 3 months. Okay. So this is all that we have to do today. After 3 months, what will happen? One, you will receive Australian dollar 1 million from your customer in Australia, Sydney. Two, you will receive your investment in rupees with interest. And three, you will end up repaying the Australian dollar 9,87,654.32 loan with interest, which comes out to be 1 million. So you are going to receive 1 million USD or Australian dollar. You are going to repay 1 million Australian dollar as the amount you borrowed. So this will cancel out. The Australian dollar price does not impact you at all. However, you will receive your investment with interest. So you will receive the 5 crores 53 lakhs 8,641 with 3% interest. So into 1.03, you end up getting 56,96,79,100.23. I'll ignore. So this is your net inflow. Now, even if the Australian dollar is of 2 rupee or 100 rupee, it doesn't matter. You are still going to get 56 lakh, 5 crore 69 lakh 67,900. One important point here is that when you're doing a question on Forex, it is very, very important to write down the units or currency, not just in the final answer, but at each step. So this is Australian dollar 9,87,000 borrowed, converted them into rupees. So 9,87,654.32 multiplied to 56. You can round off the currency here. That is also not an issue. Then you invest this Indian rupee, deposit or lend the Indian rupee. So this you have this many rupees. This you are going to invest at 12% per annum or 3% for 3 months. Finally, you're going to receive Australian dollar 1 million from the exporter. You are the exporter, so from the importer you will receive. You will receive your investment or the deposits you made together with interest. So 5 crore 69 lakh 67,900. And you will repay the Australian dollar loan, which you had taken here, together with interest, which will come out to be 1 million. You can show this as calculation also. 987,654.32 multiplied by 1.0125. So this will be 1 million Australian dollar. Right? So you are not having any confusion, any qualms about how the Australian dollar will move. So our first answer is we will use the money market hedge. Second question, suppose he wants to borrow same amount in Australian dollar in such a manner that the receivable amount can be used to repay the amount borrowed along with interest. How much amount will he borrow in Australian dollar? So what was our answer? Quickly, team. Yes. So we will Australian dollar. Perfect. Australian dollar 9,87,654. So 654. So 0.32 shall be ignored. Next question. Suppose if Rohit and brothers borrow a designated amount in Australian dollar for 3 months in such a manner that they can pay together with interest, and then they plan to invest the same amount in the Indian spot market, what is the amount available for investment? What was the answer?
Option C.
5 crores 53 lakhs 8,624. 5 crore 53 lakh 8,641. I'm saying here it's saying 624. Why? Because I kept the decimals 0.32 also. And here it is ignored. So you can always ignore. Good, Geeta. Great. Next question. Suppose if Rohit Brothers borrows a designated amount for 3 months in Australian dollar in such a manner that the receivable amount can be used to repay the amount borrowed along with interest. Further, he plans to invest the same amount in the Indian spot market. What amount will he obtain after 3 months of investment? So, what is the total money or rupee received after having invested for 3 months at 3%? What is the answer?
Option D, 5,69,67,883.
Right. 5 crore 69 lakh 67,882 or 883. 5 crore 69 lakh 67,000. Instead of 883, we have here 900 just because we kept this 0.32 extra. Okay. So practically, it is not possible to invest 0.32 Australian dollar or to borrow. So therefore, you can always round off to the nearest currency. India definitely will round off to the nearest rupee. Okay. Supposing if the interest rate parity theory held between Indian INR and Australian dollar, then what is the forward rate between INR and Australian dollar for 6 months? Do the calculation quickly and give me the answer. Uh, Geeta, D is the answer for this one, 59.73. I'll write here the rate of interest prevailing in India was 12%, and the rate of interest in Australia five percent. So what is the answer for this one? Last MCQ. This is the last MCQ. Is the answer D? Okay, let us check. Forward rate when purchasing power parity holds good. Spot 1 plus interest rate in India divide by 1 plus interest rate in Australia. So 56 into 1.06 divided by 1.025.
$57.91.
Right. So 57.91. B is the right answer. Not D. B is the right answer. Okay. Remember, this is per annum. So you have to be very careful. It's asking for 6 months. So you will do, there are 6 months in a year. So divide by 1200, 200 plus 1. 5 divided by 200 plus 1. This gives you 1.06 and this gives you 1.025. Okay. Right. Thank you. So this is the case scenario, and this is how you will attempt the case scenarios. Okay. Before I proceed further with the next type of hedging technique, futures we'll discuss. Forwards are comparatively easy. So we'll discuss the future first. I'll just take the opposite situation. What if Rohit and brothers were importers? What if Rohit and brothers were importers, not exporters? Okay. So if Rohit and brothers were importers, and let me make it a little more complicated by giving three different rates here. So it's not 56, let's say it's 56/57. And the deposit and borrowing rates are in India 11 and 13. And in Australia it is 4.5 and 5.5. Okay. Now Rohit is a importer. So he has to pay Australian dollar 1 million. Indirectly, there is a liability of foreign currency. So this is your current position. So instead of asset, now you have a so now you have a liability. So you will create a asset. So to create a asset, how will you have an asset? When you lend to somebody else, not borrow, lend. So you have a liability of 1 million Australian dollar. You create an asset by lending Australian dollar, but lending what? Present value. So you create an asset. So if you lend somebody, that person will give you the Australian dollars after 3 months. Now, how much do you need to lend? The present value of 1 million Australian dollar. Because you are going to lend, you are going to get only 4.5%. So 4.5 divided by 400 plus 1, that will become the factor. So you will lend 1 million divided by 1.01125. So you will lend 9,88,875 Australian dollar. This time I have rounded off to the nearest Australian dollar. This will be converted into rupee. What you have lent, how will you lend? So you have to first find out how much money do you need to get 9,88,875 Australian dollar. You don't have Australian dollar in your hand, isn't it? So you have to lend them, which means you have to buy the Australian dollar 9,88,875 from the Indian market. So when you will buy the Australian dollar, ask rate will be applicable. So you will have to pay 9,88,875 into 57 rupees. The ask rate will be applicable. So you will convert it into rupees. Using the ask rate. So in order to lend somebody 9,88,875 Australian dollar, you need to have in your hands 5 crores 63 lakhs 65,875 rupees. But you don't even have that now. If you had that much money today, you could have paid for your exporter today itself. You don't have this, so this you will borrow in the Indian market. Now, Indian market borrowing rate is 13%. Borrowing rate would be higher. So borrow 5 crores 63 lakhs 65,875 at the rate of 13% per annum. So you'll take the opposite positions now. Okay. So you had 1 million Australian dollar payable. Create a situation that you have exactly 1 million Australian dollar receivable after 3 months. If you want to do that, you must invest or deposit the Australian dollars today. So the present value of $1 million would be invested in Australia today. But you don't have that many dollars. So you will have to borrow the rupees to convert this rupee into Australian dollar. So first find out how much rupee would be required. So 988,875 into 57. That much rupee is required. 5 crores 63 lakh 65,875. This you're going to borrow at 13% per annum. What happens exactly after 3 months? Number one, since you have landed Australian dollar, you will receive that with interest 1 million. You will pay your exporter 1 million Australian dollar. Okay, so this position is set. Now all you need to do is to repay your loan with interest. So repay 5 crores 63 lakh 65,875 into 1.0. Once again, 13 divided by 400 plus 1, 0325. 5 crores 63 lakh 65,875. So finally, you end up paying 5 crores 81 lakhs 97,966. Now, whether the Australian dollar is of 2 rupee, 100 rupee, 500 rupee, it doesn't matter. My outflow is crystallized. My total outflow will be rupee 5 crores 81 lakhs 97,966. So this is how the money market hedge will work. You have to think first whether you are going to receive or you are going to pay. Whether you have a receivable or a payable, create the opposite position. So if you want to create an asset, you'll have to lend somebody. If you want to create a liability, you will have to borrow from somebody in the foreign currency. For that, calculate how much Indian rupee you require, and that you may, if you have to lend, you borrow. If you have to borrow, you lend. And after 3 months, your exposure will only be in your local currency. It will absolutely not be in any foreign currency. So this is how the money market hedge or the money market instrument works. Okay. If you have any questions, you can type in the chat window. I'll take up. Otherwise, I'll move to the next topic. No questions? This CQs are clear? Case scenario?
Ma'am,
Yes.
in this question, there is one thing like as in previously we had done when. Can you please explain this lending wala part once more? Because there's confusion with the comparison. Means in last question it was exporter and here we are importer, right?
Money market hedge. You can take a screenshot of this slide. Okay. So this will become a very good note for you. For an exporter, and for an importer. The exporter will have receivables. Okay, we are talking about the Indian exporter and Indian importer. So if you have exported something, you will be having receivables in foreign currency, right? FC denotes foreign currency, right? So you will have receivables in foreign currency. Create a situation where you have exactly payables in foreign currency. Payables after 3 months or same period. So far clear? 3 months, for example. Okay. So you have receivables after 3 months. So create payables after 3 months in foreign currency. But if this is 3, this is 3. If this is 6, this is 6. If this is 9, this is 9. So far clear?
Yes, ma'am.
Now, to create payables, to create a future liability, borrow today. Borrow present value of foreign currency today. Right? Only then you'll have to repay the loan.
Yes.
Rate applicable. If one rate is given, that will be applicable. Otherwise, borrowing or higher rate in foreign currency. Borrowing or higher rate in foreign currency. Okay. So whatever the rate was prevailing in Australia, we were using that. Clear? You had $1 million Australian dollars receivable. So you created a liability that exactly after 3 months, you should have 1 million Australian dollar payables. For that, you borrowed the present value of $1 million, which is 9 lakh something in the Australian dollar. Now you are an Indian. What will you do with this Australian dollar which you have borrowed? So convert it into Indian rupee. The borrowed amount, borrowed foreign currency is converted into Indian rupee. So when you are selling the Australian dollar, bid rate would be applicable, okay? You will get less. Convert it into Indian rupee. Now, what will you do with all this Indian rupee? Invest or deposit. In India at deposit rate or lower rate. Deposit rates are lower than the borrowing rate if two rates are given. Bid and ask, so deposit rate would be lower. Fine?
Yes, ma'am.
Now what happens? After 3 months, you get exactly same amount of Australian dollars received. You pay those Australian dollars to the person from whom you borrowed. However, whatever you invested, you are going to get that together with interest. So this is crystallized how many rupee you are going to get after exactly 3 months. Done?
Yeah.
Had you been an importer, you would have payables. You would have to pay 1 million Australian dollar. Now to pay 1 million Australian dollar, create an opposite situation. Make an arrangement that you receive exactly 1 million Australian dollars. Create a receivables of foreign currency after that period. Okay? So you will receive on one hand and you can pay from the same amount will be payables. Okay? This will cancel out after 3 months.
Yes.
But to create receivables after 3 months, you must lend or deposit the present value of this. Present value of foreign currency obligation. So for that, the rate of interest prevalent in the foreign currency, that would be applicable. At what rate? Deposit rate in foreign currency. So foreign currency deposit rate would be a little lower than the borrowing rate in foreign country. Okay. So whatever is the deposit and borrowing rates in foreign country, you are depositing in that country. So lower rate will be applicable. Okay.
Okay.
Now, if you want to deposit this much Australian dollars, how will you get it? So get them by converting Indian rupee. So you're going to buy the foreign currency. So you must apply the ask rate. So this figure, let's say payables is X, receivables should also be X. You will lend X divided by 1 plus Y, whatever the rate of foreign currency. And this much foreign currency you will get by multiplying by ask rate. Okay.
Yes, ma'am.
So you need these many rupees, but you don't have these many rupees. So this also you will borrow in Indian market. Higher rate, borrowing rate or higher rate. So when you have borrowed this in India at higher rate, now after 3 months, whatever you have payables in foreign currency, you will receive from the place where you have deposited, that will go as it is. All you will have to is repay the Indian loan together with interest. And this is your outflow, crystallized, fixed. Okay, this is your receivables in Indian rupee. So you have converted your foreign receivables into Indian currency receivables, which do not fluctuate. Here you have converted your foreign currency payables into Indian currency payables, which will not fluctuate. Okay.
Yes, ma'am.
So if you are an exporter, you must borrow the foreign currency. If you are an importer, you must lend in the foreign currency. So when you borrow in foreign currency, you deposit in Indian currency. When you lend in foreign currency, you borrow in Indian currency. Opposite. So there are 3 opposites. Receivable means create foreign currency payables. For that, you have to borrow in foreign currency. And whatever you get in foreign currency, whatever you have borrowed, invest in India. Okay. But borrow in foreign currency, present value. Invest in India, present value. Finally, after 3 months, repay, receive the investments with interest. That's all. So all you are going to have after 3 months is to receive your investments with interest. So if you are receivable in foreign currency, create a payables in foreign currency. For that, you borrow the foreign currency, and whatever you get borrowed from foreign currency, convert and invest in India, the present value. And after 3 months, you are going to get that amount with interest. Alternatively, if you have payables in foreign currency, create receivable in foreign currency after 3 months. So if you want to receive, you have to deposit the foreign currency today. So if you want to deposit in foreign currency, convert how much money you require in rupee. That you will borrow in Indian rupee today. Finally, after 3 months, you have to only repay the borrowed loan with interest. This is how the money market hedge works. Right?
Yes, ma'am. Thank you.
Welcome.
Ma'am, just a minute. I should take the screenshot. Just a minute. Thank you, ma'am. Done.
Similar is how we work for the futures. Okay. I'll explain the concept of futures here. Now let's talk about derivative hedging. In derivative hedging, forwards are very simple. Simply a forward rate is given. For example, in this question, if it would have been mentioned that you could buy the Australian dollar, you can sell the Australian dollar after 3 months at 55. Then if I had entered into a forward contract, I would have ended up getting 1 million into 55 million straight away. No confusion, no fear of fluctuation. So forward rates are simple. You use the forward bid rate if you have receivables. You use the forward ask rate if you have payables. Future works on a different pattern. So firstly, you are given a spot rate. I'll continue with the same example and try to create a scenario for futures in this. So spot rate is given, let's say 56 Australian dollar to rupee or INR. The future rate would also be given. Now you have AUD futures, Australian dollar futures. Okay. So Australian dollar futures are available at, let's say, 1 AUD INR 55. Okay. So when you are having your exposure in foreign currency, Australian dollar, look for Australian dollar futures, which are available for 55. And because Australian dollar futures are available, so how many, then you have to see whether you buy or sell Australian dollar futures. So what will you do here? Since you have receivables, okay, since you are a exporter, therefore Indian exporter has receivable. A receivable person is fearing fall in price. Receivable means you have an asset. So you are fearing that the asset may not depreciate. So if you fear fall in price, that means price is higher today. So something which is high today and later on which will be less, you will sell it. Okay? Simple thing. If the price of something is 100 and in future it's going to be 90, will you like to buy this or sell it? Something is available for 100 today and in future it is going to be 90. Would you want to buy it or sell it?
Sell it.
Yeah. So you are fearing that the price will go down. Therefore, you will sell the Australian futures. Okay. So you will sell them. Sell 1 million AUD, Australian dollar. Now, exactly after 3 months, what will be given to you? Exactly after 3 months, spot will be given to you again. Let's say spot has moved to 57 and the 3-month Australian future price is, which you sold at 55, is now available at 56.90. Okay. So you have to find out what is the net receipt for Mr. Rohit. Rohit and brothers is there, no? How much will he get? So how does future works? In future, whatever the 1 million Australian dollar you are going to receive, you are going to sell them in the market only at spot. So you end up getting 57 million rupee. Okay. You end up getting 57 million rupee. However, there would be a future gain or loss. So now it's like something you sold for 55, you have sold it, short or sold, is now available for 56.90. Okay. So what will you do? It's like you have sold something for 55. You don't have it in your hand. So you're now going to buy it from the market with 56.90 and then sell it. So there would be a future loss if futures are sold and the price has increased. So how much is the future loss? 55 minus 56.90. Almost 2 rupee loss on 1 million USD. So it is 1.90 million rupee loss. So net, what you get in your hand is 57 minus 1.9. So it is 55.10 million. Okay. If you buy something, price increases, there is a gain. If you sell something, price increases, there is a loss. Future sold, price increase, loss. Future sold, price falls, gain. Future purchased or bought, price increase, gain. And futures purchased, price decrease, loss. Okay. So you sold something for 55. Now it is available for 56.90. 1.9 million is the loss. And therefore, on 1 million Australian dollar, 1.9 million. So net, you get 57 million from the market. However, because you had a future loss, you end up getting 55.10. Right, sell. So technically, basically, this should also work like forward only. this thing should also work like forward. So forward rate was 55, it will be fixed at 55. This should also work like 55 only. But here we are getting not 55, 55.10. Why this extra? Because the difference between spot and future in after 3 months is 0.10. Basically, theoretically, they should converge. This should also be 57. This should also be 57. So if after 3 months or after the expiration period, the spot and future prices are exactly same, futures will work as good as forwards. But because there is some basis risk, they do not exactly converge. Therefore, there is slight difference in what you exactly get after 3 months. So maybe slight difference can be there because of this difference. You will not get it exactly 55. If I had made it 57, see, 55 minus 57, 2 rupee per Australian dollar into 1 million. 2 million would be the loss. 57 minus 2, 55 exact. Okay. So in forward, what do you see? In future contracts, what do you see? Number one, once again, you see whether you have an asset or a liability. So looking at Rohit's case, we had an asset. Okay. What is the time? Let's say 3 months. So what hedging technique are you going to use? Futures. Now, another important problem in futures is, let's get back to that question. If I had not got exactly 1 million Australian dollar, if I had, let's say, 9,95,320 Australian dollar. So in forward, I could have booked the contract for 9,95,320 Australian dollar at 55. But in futures, there is a standard size. I cannot get into a contract for 9,95,320 Australian dollar. So let's say the standard size here is 1 lakh, 100,000. So how much Australian dollar do I need to hedge? 9,95,000. So how many contracts will I need to buy? 9.9532 contracts. Okay. So then I'll not get 9.9532 contracts. I'll book 10 contracts. I'll round it off. I cannot book the contracts in decimals. So I'll take 10 contracts because if I round off 9.95 to 10, I can also go for 9 contracts and I can leave myself unhedged for 95,320 Australian dollar. So generally, when it is very close to 10, you should take 10. Let's say if it is 9.7, 9.8, 9.9, I'll take 10. If it is 9.4, 9.3, 9.2, I'll take 9. If it is 9.5, 9.6, I can decide on anything. I can go for 10 contracts. I can go for 9 contracts. And I'll mention in the answer, until and unless specifically asked, demand of the question is that you have to round off the contracts to next number. I can say that I will go for 9 contracts, and for another 55,000 Australian dollar, I would like to take the risk. I'll remain unhedged. Or here, if I take not just so, if 9,95,320 Australian dollars were to be received, I would have sold them at 57 rupees. I would have got 56 point something, whereas my future loss would have been on 1 million only. 10 contracts of 1 lakh. So another reason why you cannot exactly fix the future outcome is because one, you don't know how the spot and Australian dollar futures will move. And secondly, you don't know whether you are going to get exact contract size or you have to round it off to some number. So having explained that, you look for the standard size. So let's say you had 9,50,000 Australian dollars receivable. after 3 months. You want to hedge using futures, and the standard size of Australian dollar futures are, let's say, uh, 1 lakh. So the number of contracts comes out to be 9,50,000 divided by 1 lakh equal to 9.5 contracts. So I'll take 10 contracts. That means I have completely hedged my exposure. Plus, I have also taken a risk of 50,000 extra Australian dollar that will become speculation. Now, futures are available at, let's say, 56. Futures will also demand an initial margin. For example, let's say per contract I have to pay 2,000. So 10 contracts into 2,000. There will be an initial inflow of 20,000 from my own pocket, 20,000 rupees. However, I'm not going to assume that I'm going to pay anything. I'm going to borrow this and repay with interest after I receive my USD, Australian dollar. So from there, I will deduct the net inflow. Now, future at settlement is 57, let's say. So if this was hedging was future Australian dollar sold. So if you have receivable, you will sell. If you have payables, you will buy. So future at settlement is 57. Because it was sold, 56 minus 57, 1 rupee loss per dollar into 1 lakh dollar per contract into 10 contracts. So I'm going to lose complete amount, right? Is it okay? 1 rupee, so I will be losing 1 million rupee. Now total inflow or outflow after converted. So 9,50,000 Australian dollar I will receive. Let's say the spot price is 57.20. This is what I will receive from the selling the Australian dollar minus 1 million loss and minus interest on 20,000. Okay. This is what will be my net inflow. Right, team? I'll explain the futures once again in the next session. Okay. If you have any questions, you may please ask. We'll continue from here. Good morning, Ashish sir.
Good morning, ma'am. Good morning. So you have done the forward and future, basically.
And money market hedge,
Money market hedge. So money market hedge is basically a replacement of the forward market, we can say.
which will equal to forward market.
Which
Yes,
is equal to
if
forward. And
interest rate
generally it is
parity.
used where the forward contracts are not available in that particular currency.
Yes, derivative.
Okay, students. So we have uh, come to the end of this session. Now, when the madam were discussing this difference between forward and future, so she had explained that some points relating to like we can say that these are some shortcomings of the future contract, like standardization of standardized set, or because it cannot be customized at all. Now, student, here it is very important to note that although there are some challenges with the future contract, but still it is used. Why it is used? Because one of the very important benefit attached to the future contract is credit risk. Okay, settle. You can say that there is no credit risk, or there is no risk in a forward contract. You are exposed to the risk of the other if other party does not make the payment. So you are exposed to the risk. But here you are not exposed to any kind of a risk. So that is one of the major benefit due to which futures are very used very frequently. Okay, and so far as the rounding of the future contract is concerned, there is some common doubt among the student. Of course, in study material earlier, there were even in one question where the answer was 5 point something 4 or 3. We have rounded off to 6. but now in the current edition we have got corrected it. So always remember, if it is, as madam has told, if it is up to 5.5, you, if it is exactly 5.5, you have the option. More than 5.6, unless the question demands anything, otherwise you can round it off to the higher side, otherwise it will be on the lower side. And whenever, one important point, whenever any unhedged portion in a future contract is there, of course madam has said it is a speculation, but in my opinion it is not speculation, rather it is an unhedged portion. Generally speculation comes into the picture when you deliberately enter into any future position, but in India, deliberately, or you can say without any exposure, you cannot enter into the future position. Another is interest on the initial margin. Of course, we are assuming that we are borrowing it, but the best way to also do it, it can also be assumed otherwise, that it is a kind of an opportunity cost. Okay, because we are making the payment today, but settlement ultimately will be made after 2 or 3 months. So we
Right.
can have to consider time value of money here. And this is a time value of money. This is a basis of financial management and strategic decision making, financial decision
Opportunity
making.
cost.
So I hope the today's session has been cleared, and now this topic will continue in the next class. Then after that, madam will take the topic of the international financial management. So thank you very much, madam, for sparing your precious time and enlightening the student. And student, thank you very much for sparing your precious time and enlightening the patient listening. Madam, just write down our contact number and email ID.
Sure, sir. Uh, Email ID is
Yeah, email ID is sfm-final @ICAI.in, and phone number is 0120 3045 956. Okay, student. Thank you very much and have a nice day. Thank you, ma'am.
thank you, sir.
Thank you. Thank you.
Thank you.
Thank you, sir.
Thank you.
Thank
Thank
you.
you. You're welcome.